Thank you, and a warm welcome to all the participants in today's webinar session. As we're about to end the first quarter of 2024, if there's one thing which continues from the past year, it's a degree of uncertainty, right? Uncertainty in the economy, uncertainty on how the outsourcing market changes, and definitely last but not the least, how pricing in services and software evolves through the times. So given that context, for today's agenda, we're going to cover three broad points. One, we'll briefly cover key expectations and requirements within the APAC market for outsourcing, both in terms of, how the market's potentially moving in terms of size and growth, and, how that translates into commercial requirements. Post that, we'll move into some specifics around price movement in 2023 that we've seen and how that projects looking forward into 2024. And then we get into, some action items on how enterprises can actually realize better value from outsourcing specific to the APAC region. Towards the end, as Brandon mentioned, we'll take some, questions and answers, both from some which we've received in advance, some we'd urge you to use the Q&A window to ask questions as we go, and then potentially close out the session. Okay. Having said that, let's move to the next page and let's see how the demand for IT and BPO services has been evolving in APAC as compared to some of the other regions. So this page, the key message is that overall, the growth in calendar year 2023 for the IT and BPO services industry, at a global level, was pretty muted, about a 1.8%, which is not surprising given the significant growth in previous years, and then suddenly there was a degree of uncertainty that came in. So a lot of the decisions were more controlled. But even within this, we see that there's a significant difference by region. Asia Pacific was relatively resilient, marking a growth of about 3.8% as compared to North America, which was practically flat at 0.1%. If we look into calendar year 2024, the growth band expectations, because as we project into the future, we like to see present a bit of a range rather than an absolute figure. North America, yes, it's going to potentially improve, right? Marginally till about 1.5 to 2.5%. But APAC is again going to be pretty much faster growing than the North America and Europe regions at anywhere between 4.5 to 5.5%, right? So net, the resilience potentially is going to continue within the APAC region, which is good from the perspective of the market. So that's a little bit of the context on how the APAC demand has shaped and seems to be shaping up. Rahul, APAC in itself, I've been using the term APAC as a whole, but in itself is quite a varied region, right? Is there some further differentiation in markets that you see among the major countries? Do you want to shed some light on that?
Yes, absolutely, Abhishek. So there are various differences between the key regions in APAC. And if we move on to the next slide, the differences could be across various dimensions, such as IT maturity and digital inclusion, economic maturity, the overall provider ecosystem and how mature it is. Some of the macroeconomic policies, could also be drivers of differences, as well as other government policies and regulations. For instance, if you look at Japan, Japan is a highly mature economy with a relatively slow pace of growth. In 2023, there were some signs that the economic growth in Japan would be different from what was observed historically for many years, and it would kind of increase a bit. But towards the end of 2023, that trend ultimately, was, it did not hold up. We saw again a slowdown in economic growth over there. That combined with the fact that, in general, there were a lot of large deal opportunities, since enterprises were trying to cut costs. They were trying to consolidate their vendor base and get more competitive pricing. That also was a big factor over there. Combined with the fact, with that there are actually not too many senior tech professionals available in that region. There is a shortage of professionals, and that kind of brought the entire cost economics in a lot of conflict. On the one hand, costs had to be brought down. On the other hand, talent was coming at a premium. So a very unique set of characteristics playing out over there. In contrast, if you look at, let's say, Greater China, China, Hong Kong, what we have seen is some of the large tier one global players, they are not, that strong, in the region. And there are a lot of local players, which have a dominant share of the market. And given that the China region was also going through an economic slowdown after many years, that brought up a different set of challenges to deal with. Contrast that with India, where the growth has been actually pretty robust, and there are strong digitization mandates among various enterprises, so that means it's a really growing market from an outsourcing and tech services standpoint. However, with regard to the parameters that are used by enterprises to select vendors, we do see a lot of legacy mindset. Some of the aspects such as going by the credentials of the enterprise, the kind of case studies, the kind of references that it is able to bring to the table. These are not as strong parameters, let's say, in a North America or in a European region as compared to what we kind of saw in India. So a different set of dynamics over here. And likely, on similar lines, if you look at South Korea or ANZ, again, a different set of parameters. For example, in Australia, the delivery costs are, they're kind of increasing. But at the same time, what makes it interesting is that, the government is actually committed over there, for digital growth, and they have a digital economic strategy, for 2030. And that's leading to a rapidly rising demand for technology roles. So net, it's clearly not a homogeneous region. There are, a lot of nuances, a lot of variances across different markets, which require essentially, from a provider's perspective, different strategies to win market share. And from the enterprise perspective, there are a lot of different underlying factors which they're trying to address as far as the underlying intent and objectives behind outsourcing. That being said, Nirti, let me hand it over to you, and if you have any points to share with regard to what we saw as some of the savings drivers last year in APAC.
Sure. So thanks, Rahul. That was some interesting coverage on the uniqueness of the APAC region as a whole. So now if we move to the next slide, we'll see that over 2023, while the outsourcing model has continued to grow and mature, we observed key saving drivers for the APAC region. So over the past year, many clients in the APAC region have expanded their outsourcing portfolio by adding cost-effective centers. Now, this expansion has allowed clients to diversify their geographic footprint, help them mitigate risks associated with over-reliance on a single location, and also help them by tapping into different talent pools and markets. Adding cost-effective centers to the outsourcing portfolio offers significant cost savings due to lower labor and operational costs without compromising on quality. Additionally, each region has its unique strengths and expertise, allowing clients to strategically select new outsourcing centers and again gain access to specialized skills that may not be readily available in their current locations. We also found that a lot of APAC clients invested in benchmarking of existing spend. Benchmarking existing spend is a strategic investment in efficiency and optimization. It involves evaluating current expenditure against industry standards, best practices, and peer performances in order to identify areas of improvement. Clients also gain valuable data-driven insights into their spending through benchmarking exercises. They are able to understand their spending patterns, cost structures, and vendor performance. Through benchmarking exercises, clients were able to identify cost savings opportunities by highlighting areas where they might be overspending or even underutilizing resources. Now, in the last year, clients have been engaging more with their preferred vendors we found instead of diversifying their options. This shift was basically due to increase in client satisfaction, decrease in client satisfaction caused by the difficulties of managing multiple vendors. To address this issue, vendors have been consolidating their portfolios to improve their operations and the quality of their services. As a result, clients have been assigning bigger projects to their preferred vendors, focusing on established partnerships and enhancing the overall efficiency. Now, lastly, clients are also we're also embracing changes in engagement and pricing models, emphasizing a shift towards greater vendor accountability. They were expecting more skin in the game from the vendors, service providers. There's a growing trend of clients seeking outcome-based models, aligning vendor incentives with the achievement of desired results. Additionally, clients are transitioning towards output-based models in managed services agreements, offering which gives them basically the flexibility to scale according to their evolving needs. And this shift underscores a mutual desire for agility, efficiency, and value-driven partnerships. Now, this is what 2023 looked like. Now, Dev, what do you think 2024 holds in terms of key business challenges?
Sure, yes, Nirati. As some of you might be aware, right, at the end of each year, we conduct a study to understand the key challenges that the enterprise is aiming to solve in the next year, so 2024 as of now, right? And in there also, not surprisingly, right, we see cost and margin pressure, ever evolving customer needs. These remains the top challenges in 2024, and these are in line with what we have seen in 2023 as well, right? 2024, what we believe will be a year of doing more with less. That's the broader theme for this year, right? Because the enterprises are focusing on getting more value out of and then achieving higher efficiencies while operating with much leaner resources, right? And they are prioritizing the revenue growth through the streamlining of efforts and other cost reduction strategies. And if we move ahead and look at a slightly positive side, right, we do see the talent situation easing out, right? So if you look at the slide, right, you'll not find a talent-related challenge being there as of now in the top five, right? Because we believe that it is significantly eased out and easing out further, right? And just to give you some context, that was a number one challenge when we looked at the similar study in 2022. Still was a ranked at number three in 2023. It eased in 23, but still was one of the key challenges. But now it has subdued and it's part of top 10, but again, not highlighting in the top five challenges. Moving ahead, slowness in demand. Again, that continues to be a major challenge going into 2024 as well, because the demand is expected to remain muted this year as well. And this is primarily due to the looming fear of the challenging macroeconomic conditions and the geopolitical tensions that persist around the globe. Right? And clearly, again, recession is a theme that is there in everyone's mind as of now as well, right? Which was there in 2023, in the parts of 2023 as well, right? And to substantiate that, we are already seeing certain instances wherein there is delay is happening in the decision making, and that too, especially around the big transformations themes. And clients are a bit averse as of now to take on any big transformation projects without having the sightedness in terms of what lies ahead for them. So that's a high-level view in terms of the challenges the enterprises are facing. I'll hand over to Abhishek, and Abhishek, it would be interesting to see how these correlate to the key themes that APAC buyers are focusing on right now.
Sure. Thanks, Dave. Thanks for sharing the good context on the business challenges expected. Before we get into some of the key questions that we're being asked, let's run on the next page a quick poll. Requesting our participants to select all that apply. Right. So it's not a it is actually a multiple choice question, but with things where we request participants to please choose which of these themes that you believe are the top of mind, for APAC buyers. So we'll just give it perhaps a few 15-20 seconds, right, to see where things are going. Rahul, I think it's difficult to predict which one will outshine the other, because all of these seem to be pretty important, right, in today's day and time.
Yes, I think these are all very important. But just going by the amount of buzz, that is currently there in the industry, I think I'm expecting to see generative AI definitely being among the top, let's say at the top rank, or it's the number 2 rank. And also just keeping in mind the kind of economic challenges, that are being faced by clients, globally and APAC as well. My hunch is that even the competitive rates aspect, might figure prominently.
Yeah, and you're spot on. So, if we can see on the screen, getting competitive rates ranks highest, no surprises. But then Gen AI, I think there's hardly any conversation these days related to efficiency or, what's next for IT and business services where Gen AI doesn't come in. So it's a very close at kind of 72% of the respondents have actually mentioned that to be pretty important. I think, the whole change in pricing models and better payment terms are more fundamental structural elements. But, good to see that almost a third of the participants do feel these to be important as well. So yeah, thanks for that. I'll now hand over to Rahul to talk about maybe the questions that we are being asked, our representation. So Rahul, over to you.
Yep. Thanks, Abhishek. So the questions which are, if you go on to the next slide, the questions that we have seen, the clients asking last year, and even the first quarter of 2024, they are actually pretty much on the same lines as what we kind of talked about in the poll. But if we have to kind of do a ranking of that, the number one question, is with regard to to what extent can enterprises push the rates down. And the rationale for that is basically, if you kind of just take a step back, after a very long period, 2022 had emerged as a year where it was basically a service providers market, and providers were able to get, favorable pricing, favorable terms and conditions in the contracts. But in 2023, we saw the pendulum swinging back in favor of the buyers. Hence, a very logical question that buyers asked themselves, in 2023 was, how far could one push down the prices, without impacting the quality of services or the delivery resilience, so to say. So basically, was there merit or is there merit in pushing the providers to give a better deal? That's the number one question that frequently came across. Second one, as the year went by, questions around generative AI started becoming more and more frequent. Clients across various industries in APAC wanted to understand what productivity improvement can generative AI bring to the table? And is this essentially a strong lever to drive additional savings? So that's a question which was very prominent. The third one is again a logical one, right? Given the tough economic conditions, with very high interest rates, clients wanted to conserve cash, hence wanted to know whether it is practical for them to push for extended payment periods. And lastly, is this the right time to aim for more of output based and outcome based models? And more importantly, what are some of the prerequisites to check for, in order to make sure that if ultimately some of these models get adopted, they prove to be a success, and what are the pitfalls to avoid, essentially. So a lot of conversations on these lines. Okay. Let's move on. Okay. Now with that as the background, maybe the next step that we should do is uh, look at some of the recent pricing trends in the APAC region, as well as what we see as the future outlook for pricing. And equally importantly, what are the key factors which are driving these pricing trends and our outlook for pricing in the APAC region. Dave, would you like to walk our audience through these details?
Sure, Rahul. So first, taking a step back, right? And then if you move to the next slide, please. Yeah, thank you. So again, taking a step back, and then as Rahul mentioned, right, 2022 was a year of service provider, right? We see 2022 as an exceptional year, I can say, right, in terms of price increases across both traditional and the next-gen skills. And then we have seen some unprecedented growth, so as to say, right, in certain areas pertaining to next-gen skills, cloud, cybersecurity, on the agile DevOps side, domain-intensive BPO skills, all those areas, right? More prominent in those areas, right? And in contrast, if you look at 2023, right, it's a significantly muted year. Right? Globally, the FTE prices remained stable in these last 12 months, and APAC as well is no exception to that, right? But however, there are some interesting things to note that in certain next-gen areas that I talked a while back, right, cloud, cybersecurity, the next-gen application side of skills and the BPO intensive, the domain intensive BPO skills, right? Those are the areas where we have seen demand or the technical talent demand more so in countries like Australia and Singapore, right? And because of this, the FT rate increases for these areas in the last year were 2.5, 2.7% growth for these areas, right? And again, that's pretty much the similar story if you look at offshore as well, but more prominent and then the onshore, which is Australia and Singapore. And if you look at the overall picture from the traditional skills perspective, which are broadly on the left side of the screen, right? What we have seen is broadly the decline of 0.5% to an increase of 1.5%, right? That's the broader range we have seen across the rate changes across different type of skill, right? Which is almost, if we average it out, remains a flattish type of a trend, which is a broader theme that was there in 2023 globally, right? So that's a view in terms of how the price movements have been in 2023. Whole and whole remained flattish, but slightly heavier on the or slightly more growth on the next side of the scales, but remaining flattish as the overall message from here, right? And now it would be interesting to see how the pricing and outsourcing services would likely play out in 2024, right? So, Nirti, could you please take us through that?
Sure. Thanks, Dave. Thanks for covering what 2023 pricing trends look like. Now, before I go into the pricing forecasts for 2024, I would like to cover what are the four factors that are likely to impact the pricing in 2024. So the first would be the geopolitical landscape, particularly in Eastern Europe and West Asia, is becoming increasingly volatile. There are ongoing conflicts and geopolitical rivalries in these regions, which pose significant risk to regional stability. And now, should these tensions escalate and spill over into neighboring areas or major trade routes, the repercussions could reverberate throughout the global economy. Disruptions to supply chains, fluctuations in commodity prices, and increased geopolitical risk premiums could all contribute to economic uncertainty on a global scale. The second would be the global economic uncertainty and the potential recession. The global economy is expected to face continued uncertainty throughout 2024. Now, with the potential for further economic deceleration and the onset of a recession, the uncertain outlook may lead to cautious consumer spending, reduced business investment, and decreased demand for goods and services. Now, consequently, there could be volume cuts, delays in execution of large-scale projects, and a deferral of transformative initiatives due to the prevailing economic uncertainty. Uh, the other factor would be the client say focuses on vendor consolidation or continues to focus on vendor consolidation. Many clients are intensifying their efforts to consolidate their vendor relationships. Now, by streamlining their support base, clients aim to achieve greater efficiency, reduce costs, and simplify their procurement processes. This trend presents both challenges and opportunities for vendors. Vendor consolidation initiatives can serve as an enabler for sharper pricing strategies in the market. As a larger number of suppliers compete for a limited number of contracts, there may be downward pressure on prices as well as vendors seek to secure or maintain their market share. This shift away from piecemeal negotiations would program it towards programmatic consolidations emphasizes the importance of offering competitive pricing while delivering high quality products and services. The last but not the least, there could be widespread predatory pricing. Now we know that with clients focus on cost management, providers are grappling with near stagnant revenue growth. Now, this might prompt some of them to resort to widespread predatory pricing tactics in order to win new deals or even to retain their existing clientele. Now, assuming these four factors remain stable, and we let's move on to the next slide to see how the pricing might move in 2024 for IT BPO services. Uh, for IT standard services encompassing traditional IT applications and infrastructure services such as development and maintenance activities on standard technologies, we anticipate a slight decrease in pricing ranging from minus 0.3% to 0.4% for onshore locations like Australia and Singapore, and a minus 0.7% to 0.2% for offshore locations like the India and Philippines. Overall pricing for standard skills is expected to remain relatively subdued. Conversely, for advanced skills in IT applications and infrastructure services, for example, development and maintenance activities on premium technologies, we anticipate a price increase of 0.5% to 1.5% for both onshore and offshore locations. This increase is expected to be moderately higher than the traditional skills. Now, additionally, for BPO services such as common voice and back office services, we anticipate a moderate reduction in pricing or even stable prices for both onshore and offshore locations. Now, Abhishek, how do you think how enterprises can realize better value from outsourcing in these challenging times?
Sure. Thanks, Nirati, for sharing these details. If you move to the next page, we've actually come to the third section, of today's webinar, because till now we've talked about the expectations, the price movement, which is a good segue into this section, which is around how can enterprise really realize better value from outsourcing. What are some of the themes shaping them, levers to optimize spend, and then some contracting guardrails. If you move to the next page, you know there's three themes which we believe that'll potentially impact enterprise, spending, right? First is, of course, contract benchmarking. Please note this is over and above just price benchmarking, right? Because it's just one part of price is just one part. There could be other things like terms and conditions, productivity glide path, performance metrics, a lot of other things which could kind of come into play. The solution, the underlying sizing of the solution, which is super critical. So I think, and we already see a lot of questions and interest in getting contracts benchmarked end to end. The second element is portfolio rationalization. See, for buyers, there's a limit to how much can be achieved through just simple ongoing discussions and negotiation. Sometimes a shake-up, if I may use the term, is needed, which enterprises are following diligently, right? Given the ease of the talent crisis, there is a bit of a reallocation of portfolios among kind of different vendors to see if there is an overall better pricing which can be had, either by use of competitive tensions or offering better scale or bigger scale, right, to one of the providers in lieu of a better price. The third is savings via innovation, right? And innovation is going to be the keyword here. Often used levers of traditional re-engineering or automation seem to be flattening out, especially in third, fourth generation deals. There are proofs of concept POCs with service providers who assess the impact of Gen AI, as was evident in the polls. Also, it's pretty much top of mind. There is significant demand or ask from clients, enterprise clients, buyers, to understand from providers around how Gen AI can be used to impact overall total cost of ownership, and a lot of these are gathering steam. You'll notice a material alignment with the themes we spoke about in the poll and the slide which Rahul talked about, right? So if we look at most asked questions, right, going into 2024, right, of course, rationalization of provider portfolio, are bill rates likely to decline further, right? And that's where the whole contract benchmarking come in. Should they lock in rates for the next 2 to 3 years? Is it really, is there a potential of it going up again? Because what no one realized in 2020 was that there's going to be such a hairpin bend of rates really going up. So there is a bit of a question. I mean, does it make sense to lock in now? And then how are peers buying Gen AI, right? Yes, as a concept, I think people have started to understand it. But then what are the costs of running Gen AI in the environment? How will it impact productivity? So a lot of these questions, both around cost as well as return on investment related to Gen AI, are pretty much top of mind. Now, having said that, I've spoken about the sources of value leakage, that are important apart from just overpricing of rates, right? What are some of those, and do you want to describe their potential quantum of impact?
Sure, Abhishek. So as Abhishek, you rightly mentioned, right, that value leakages in contracts that goes beyond pricing itself, right? And in our advisory experience, what we have observed is more often than not, the compromise happens with regards to let's say solution sizing in itself, right? Inappropriate pricing structures that exist, a mismatch in terms of productivity expectations versus the attainment, and some clear shortcomings as well in terms of the contractual terms and conditions. And all of these have a different degree of impact in terms of the overall value leakage that is happening from the contract. And then that you can see on the screen, right, the different degree of impacts of all these different leakage sources, right? Delving down to these sources, right, under solutioning or overestimation, both are quite common, and then that is even for the commoditized services like the application maintenance services or the traditional infrastructure operations as well, right? Although most of the mature service providers, right, have all the required frameworks, estimation methodologies in place, right, which goes beyond, let's say, the ticket-based sizing for support services. And we do often see that there are gaps in pyramids, in the right location mix, in terms of the productivity levers, and then some of the other nuanced sizing parameters as well, right? And this parlance also holds true, right, with regards to the transformation services as well, right? Wherein the solutioning at times doesn't translate to the client's existing technology landscape, right? These mismatch scenarios are more pronounced for less mature buyer segments, but at times we have observed that even for third or the fourth generation outsourcers, there are these leakages that are happening. Right? All in all, so basically ambiguous terms and condition, lack of performance-based incentives, inadequate structure, inadequate, I'll say, structured risk-sharing mechanism. All these can lead to not only value loss, but this also impact the overall buyer-provider relationship, so as to say. So by strategically, I'll say managing these solution sizing, pricing structures, productivity, contractual terms, all these rights, organization can enhance the overall value that they can derive from the outsourcing contracts. And the potential savings that's there on the slide, right, in terms of the percentages, right? These are significant for any enterprises, may it be small or large scale of operation, right? To have more deeper conversations during the sourcing phase in itself. So that's pretty much from the leakage sources perspective and how we can tackle those scenarios. Nirti, it would be great if you can share your thoughts on how benchmarking around these parameters can be more crucial, more beneficial for the enterprises.
Sure, thanks, Dave. So now if we move on to the next slide, uh, we see that in the penultimate year, prices were on an upward trajectory. However, in the last 3 quarters, we have observed a stabilization in prices. This presents an opportune moment for enterprises to assess and benchmark their IT services costs. In an uncertain environment with a primary focus on cost management, even a modest 2 to 3% rate adjustment can yield significant ROI for mid-size outsourcing portfolios, potentially going up to 20-30 times. Now, to achieve successful benchmarking, it is crucial to obtain relevant and up-to-date data and put it in the proper context. Uh, the term right data refers to information obtained from current deals to ensure accuracy and relevance to the market. It is also important to use data that is not more than 12 months old in order to reflect the current pricing trends accurately. Additionally, it is also essential to consider the deal's background when comparing rates for different roles or regions. For example, one cannot benchmark data engineer rates against data modeler rates, although both roles might belong to the same job family. Similarly, one cannot benchmark rates used in the APAC by providers against Europe rates for same set of providers. It's important that you consider the forward-looking perspective when you are evaluating the benchmark. While the rates have been stable, it's also crucial to take into account what the future might hold. Uh, Ensuring that the appropriate contextualization is paramount in benchmarking exercises. This involves aligning nomenclature, normalizing contract terms, and assessing service metrics meticulously. What exactly does correct contextualization and normalization entail? For instance, when comparing two deals involving similar technologies and scope of work, variations even in COLA and FX term can exist. One deal might include COLA within its rates and the other does not. So it is imperative to consider normalization factors while benchmarking in order to ensure that the comparisons are accurate, thereby comparing so that you are comparing apples to apples rather than comparing apples to oranges. Additionally, factors such as environmental considerations and justification for premium rates should also be considered. For instance, when benchmarking an application management services or AMS deal, does the analysis consider the outsourcing maturity of the enterprise? Such things should be considered. Uh, And such considerations are pivotal in determining the productivity offered within deals. These are only small few examples of doing right benchmarking activity, but benchmarking in itself is an extensive and important exercise which enterprises are using to align themselves right in the market. Now, if we move on to the next slide, we'll find that alongside traditional benchmarking practices, enterprises are also strategically leveraging challenger providers to ensure competitiveness and drive innovation in service offerings. Enterprises are proactively introducing challenger providers into the competition, prescribing them rates within the 10th to 30th percentile range, and this is indicative of the competitive pricing on the benchmarking spectrum. These challengers often are the tier two providers or even the tier one providers who are trying to get a foot in the door and disrupt the incumbents' dominance. Uh, the presence of the challenger providers encourages incumbents to reassess their positioning and competitiveness. Now, facing the threat of losing market share, incumbents are compelled to innovate and differentiate their offerings in order to maintain their foothold. Competition from challenger providers also stimulates innovation and drives improvements in service quality. Additionally, incumbents are incentivized to invest more in R&D, enhance service capabilities, explore new avenues for value creation to stay ahead in the competitive landscape at the vendor side, at the client side. Moreover, introducing challenger providers prevents incumbents from becoming complacent in their offerings. It also fosters a culture of continuous improvement and adaptability, ensuring that providers remain responsive to evolving market dynamics and client needs. Now, it is crucial for enterprises to determine their position on the benchmarking spectrum and take action to manage their expenses. If their pricing falls within the premium or inflated range, it is imperative for them to implement tactics so as to adjust their price point to a balanced or competitive level. Now, Abhishek, what do you think? What are some of the other methodologies enterprises can adopt apart from the benchmarking exercise in order to create more value out of outsourcing deals?
Sure. Thanks, Niriti. And if you move to the next page, I think the clear message is that discounting teams have picked up even more steam, right? With the high spend being rewarded with better outcomes. So all of these things that I mentioned here, in colloquial terms, might be called deal sweeteners. But these sweeteners can actually, make pretty much a significant difference when we're talking about, millions of dollars or, whatever currency we're dealing in. So none of these honestly are new, right? It's just that we're seeing these being played out much more aggressively, in different deals. Buyers today have a heightened expectation around pricing flexibility, and service providers also are notably responsive, right? Because there's much more in many of our conversations. Providers are keen to grow their business, right? Even if it means getting a bit more relaxed on margin, right? So again, and it could vary from company to company. I'm not generalizing that everyone does it, but the trend seems to be there. Most of them are now offering these levers more than they would have done a few years ago. Definitely in 2021, 2022, many of these disappeared, right? For example, the no cost of living adjustment contingency. It was hard to kind of even mention this COLA waiver or anything like this in 2022 because the ask was 7%, 8%, locked in given the inflation. But today, even in sole source deals, right? These discounting levers we're seeing at play quite often, right? Which is a departure from practices generally seen. There are more providers, for example, are much more open to foregoing termination fee, agreeing to flat discounting for mid-sized deals also. There is a pushback from buyers on COLA and FX inclusion, and so on and so forth. So depending on the deal size and relationship and competitive tension, a number of these could actually play in For example, like offshore discounts and amortization strategies are also emerging as integral components in the negotiation playbook. So by offshore discounts, we'd mean that, let's say there's an Australian client, there would be a discount applicable for scale, but over and above, right, the certain baseline of offshore ability, if the client would be more open to look at, a higher degree of offshore for the services, there's an additional discount applicable. And not surprisingly, because the margins generally for providers are higher for offshore delivery from India or Philippines or and so forth, right? So again, there's a lot more focus, to summarize, on flexible collaborative pricing models that meet the evolving needs of the specific customer or the market as a whole. Just trying to kind of make the deal overall amenable from a commercial perspective. Now, these are kind of what we speak about point solutions, right? Specific. If you move to more fundamental changes in delivery structures, Rahul, I'm sure the audiences would be keen to hear our perspective on Gen AI and its leverage in sourcing contracts.
Yes, rightly so, Abhishek. And if we move on to the next slide, productivity improvements and savings potentials have, actually plateaued, in mature outsourcing arrangements. And to overcome this stagnation, buyers and providers are exploring, what generative AI brings to the table. And it is old news that providers are investing heavily in generative AI. Several proof of concepts last year were conducted across BPO as well as IT services, and they have revealed that generative AI has the potential to drive savings. The question now is, how can buyers and providers take these proof of concepts into production, so that incremental benefits can be passed on to the buyers. We have observed that when pushed by enterprises, providers are actually coming up with credible use cases that can be taken into production. As an example, as we are showing on this slide, in contact center deals, we have seen cases of generative AI, in, let's say, first of all, addressing the contact origination itself. It can help in reducing the number of contacts that are originated by enriching the FAQs and the knowledge bases. And then, generative AI can also help in addressing the contacts, once they get originated. They can help increase the digital containment rate. And, towards the end, they can also help in reducing the average handling time to fulfill the contacts via auto identification of intent, agent assist features, and also enhancing after-call work productivity for the agents. And similarly, in other functions like application maintenance, application development, help desk, workplace, we have been advising buyers and providers on recent market developments, on the next gen themes and many other topics. So definitely, this is an area, which has seen a lot of, I'll say, evolution in the last 12 months. And, we actually expect to see, even more, of these to happen in the current year. And that transition from proof of concepts to moving the use cases to production and actually, contracting or providers committing around the benefits for clients, all that is happening now. Moving on. Yeah. So in the last few months, many clients have reached out to us to get a brief on the evolving themes around productivity, impact on the existing volumes, the overall account and, vendor strategies, so on and so forth. So to address some of these points, we are offering today a complimentary primer to our audience. The primer would essentially include recent trends impacting commercial landscape for IT and BPO services, a correlation of supply performance trends, and how they are likely to impact future pricing behaviors. We're also including some anonymized deal examples, which would be interesting for our audience to have a look at. To get access to the primer, you can click on the link shared in the chat, and the team will get back to you. Abhishek, over to you once again.
Great. Thanks, Rahul. If you move to the next page, this brings us to the last section of the webinar. We'll take a few questions, but before that, thanks, Rahul, Nirati, Dev, for the insights, and to the participants for the questions that have kept coming on. We'll take a few of them, and for the remaining, we'll try and respond, offline. One of the questions which came through, was around, the changing commercial models that the APAC CFOs are looking for. What do they look like? Rahul, would you want to take that one?
Yes, absolutely. So we have, clearly seen, that there is, the objective of CFOs to ultimately ensure, more skin in the game for the service providers, and also look at ways in which some of the capital expenditure, for the enterprise can be converted into, operating expense. So both of these are kind of driving, an uptick in output and outcome-based pricing models. We're also seeing instances where, beyond the traditional output-based models and, some of the outcome-based models, there are other innovative commercial models that are being adopted. These include, asset-based financial engineering, build, operate, transfer constructs. Let's say while setting up a GCC in India, the enterprise not investing upfront into the setting up of the GCC, but taking support from service providers running them for some time, and then ultimately transferring them back to the enterprise. So there's a lot of action happening on these, interesting times.
Perfect. Thanks. There was another one around, what some of the primary pricing differentiators we see in the, let's say, between the APAC, EU, US markets. Nirati, you want to take that one?
Yeah, sure. Thanks, Abhishek. So APAC is more cost aggressive in general, I would say. There are certain few exceptions like Singapore and Japan, but India, China, Korea, etc. Are kind of cost conscious markets compared to the EU and US markets. And to back that up, we have also seen that certain financial incentives like volume discounting. If we go and see in APAC, the the clients are very sensitive to that, and for that reason, for the same level of spend, say in the US market, when we compare that to the APAC market, we see that the APAC market has a slightly higher volume discounting. So this is one of the reasons why you see higher volume discounting, because of the cost aggressiveness. So that's in general how it is differentiated.
Thanks, Nirati. I think we'll take one more question, and I'll answer this one. So there was a question that while GCC has expanded in India, what do the long-term and short-term cost perspectives look like, right? Especially how do they work out between outsourcing to India versus offshoring to a GCC? Very interesting question. I'll start by stating the obvious, that in the near term, because of the significant investments in setting up a GCC, obviously outsourcing tends to be more attractive, right? No marks to me for saying that. But at the same time, as we get into the medium and long term, we've seen multiple cases where GCCs, from an overall run cost perspective, are actually turning out to be, similar or even lower price than what perhaps competing solutions would be in the outsourcing space, right? If I were to point my finger at one of the key factors around this, would be GCCs, which are kind of, operating within, as a delivery innovation focused entity, right? And keeping cost structures similar to that, I think are able to achieve this pretty well. Historically, many GCCs have taken the route that, small things like furniture and computer and the pens being used have to be consistent with every office across the globe. Surprise, surprise, the cost goes up significantly, right? Because those little things just add up to thousands and eventually millions of dollars, right? So yes, there's no single answer that will a GCC be, more cost effective or more expensive to run. It depends much more on the philosophy, but net, there's enough and more examples around where GCC does not have to be, more expensive to run in the long term. I'll just touch upon also the point which Rahul mentioned a minute ago around the whole things like build, operate, transfer, right? Assisted captives. So many organizations, there seems to be a rush among many enterprises to look at that option while setting up a GCC, right? So build, operate, transfer, run as an assisted captive, take some services for a longer term to speed up the process, make things efficient. So rather than just a de novo GCC setup, we're seeing much more of this hybrid GCC setups, which have overall, general cost and cash flow benefits, which enterprises can take benefit of. Right? Okay, I know we have 3 remaining minutes. We just wanted to quickly, perhaps talk through how, Everest Group assists procurement teams and some more of our capabilities. Dave, over to you to quickly cover some of that.
Sure, Abhishek. We just wanted to leave you with how we support the enterprise procurement and vendor management teams in capturing great value from the outsourcing. And if you can just talk about the details. Yeah. The next slide, please. Yeah, thank you. Yeah. So how we support the enterprise procurement and vendor management team, right? So we do this via 2 options, right? There is an ongoing membership model on the left side of it, and we also do one-time projects which are depicted on the right side of your screen, right? The first membership that is there is which we called outsourcing and excellence, right? Which is essentially designed to provide clients with broad-based market intelligence on topics such as sourcing strategy, outsourcing solution design, and risk management, right? The second membership on the bottom left is what we call as pricing analytics as a service, which is essentially designed to be more focused on pricing along with performance and contracting. The main focus of this particular membership is to get to an optimum spend reduction and then sustain it going forward, right? As I mentioned, we also execute a range of one-off bespoke projects covering themes such as rapid cost takeout, price benchmarking, location portfolio strategy, provider rationalization, and some more on those lines, right? Now I'd like to hand it over to Niriti to quickly double-click in terms of our coverage from the pricing support perspective.
Sure. Thanks, Dave. So people might be wondering what is the source of all the pricing insights and guidance that we share. Now, we work with a lot of enterprises in the pricing analytics as a service model. And as a part of that, we not only share pricing intelligence with them, but we also get current information on their pricing. And we have in our database more than 400 roles, more than 150 RUs in close to 50 locations across the globe, covering various BPS, IT apps, infrastructure, consulting, and engineering services functions. Now, I hand it over to Rahul so that this is so Rahul, why don't you take us through our capabilities on SaaS and cloud products apart from the price benchmarking that we do?
Sure. I'll just be quick about this because we are kind of at the top of the earth. So from the perspective of SaaS and cloud products, we cover benchmarking for various types of products, ranging from, let's say, Microsoft M365 to some of the industry-specific platforms like Guidewire and Facets, industry agnostic products, CRM and ERP systems such as Salesforce and SAP, ITSM products, cloud platforms like Azure, AWS, and GCP, etc. So do feel free to reach out to us if you have an upcoming software or contract, cloud contract purchase or renewal. And
right. Thank you. Thanks, Rahul. And before we close out on the last page, just pointing participants to our blog, where you can check out some interesting perspectives from our analyst teams on global services. We are at the top of the hour. Thank you so much for joining in, to all the participants, and thanks to my co-panelists for sharing the insights. Hope everyone has a good day. Thank you.
Thank you.
Thank you, everyone.